So let's look back quickly. For all the uncomfort and uncertainty you're talking about, Scott, the S&P was up about 6.5% in the first quarter on relatively low vol. So the market performed quite well. Underneath the surface, there was a lot of change and volatility. You had value outperform growth by close to 30%. If you were long a portfolio of the VIP stocks at Goldman Sachs and short the most shorted stocks, you underperformed by 28%. If you were long momentum underperformed stocks that didn't have momentum by 18%. So the factors that were driving the market changed a lot during the first quarter. Why was that? That was because interest rates moved. You had an 84 basis point move in the 10-year. So, there's a question of what's driving the market. With that said, the market continues to perform well. My guess, the same narrative will continue into Q2. And what I mean by that, we're about to see the best April and May in terms of GDP that we've ever seen. My guess is it could be the best April and May for the economy that we see in our investing careers. The amount of growth as the economy reopens will be unequaled. So I'm hugely confident that the economy is going to grow. I'm very bullish on the economy. There's a massive amount of liquidity. So there's $4.4 trillion sitting in money market accounts. I think retail has $1.5 trillion of that, almost $1 trillion more in money markets today than a year ago. Because everything's been shut in, there's been $1.5 trillion of forced savings. Consumers haven't been able to spend that money. Some estimate by the time we fully open, that number will be $2.5 trillion, 12% of GDP. So the combination of lots of money and the world reopening, I think clearly has to be constructive for equities. With that said, interest rates are clearly going to move up. I'm not sure how much. Everyone expects rates to move up. They're 170 today. I think the forwards expect them to be 192 by year end. But even over the next 5 or 10 years, the forwards on 10-year rates are like 225. So rates are going up, but it's not a very, very high rate environment. So the combination, and the rates are going up for the right reasons, hopefully, right? It's going up because the economy is reopening. We're doing a handoff from massive monetary policy that got us out of the COVID shutdown to fiscal policy. So there could be different stocks that work in the market. I'm not smart enough to know if you want to own, what factor you want to own. But generally, I think it's a constructive time to own equities. Risk return may not be as good as it's been in the past, but given how strong the economy is going to be and how much liquidity there is, I think you probably want to be long equities. We at Corvex are balanced between owning things that are, quote, reopening trades, the casino type names, the MGMs, where, my guess is, I don't have a crystal ball, but my guess is they're about to see massive pent up demand, and behavior in May and April will be, record-like in terms of consumer activity. So we have about a third of our portfolio in names like that at reasonable values, buying stocks, not buying the market, but levered to the world reopening. We have about a third of our portfolio in what I'll call GARPy growth tech names, where I'm comfortable with my valuation support. I don't care if interest rates are 2 or 3. Frankly, the stocks are probably worth more if the 10-year is 3 because the economy is growing. To own names like Amazon and Google and Microsoft, great businesses at reasonable valuations that frankly are going to grow a lot. And if the economy grows, they'll grow more. So I don't need to discount those stocks, those cash flows off a 2% 10-year to have them work a couple multiple turns higher than the S&P. And that's about 25 to 30% of our portfolio. And then the other 40% hopefully sits in where we're buying, idiosyncratic stock stories, where we're buying value that's been thrown out. So companies that are not directly affected by COVID, that are defensive businesses with high quality cash flow streams that are going through events, where I like the valuation. So is it T-Mobile buying Sprint? Is it Altice, a predictable, cable company with very predictable cash flows that's using money to invest for growth and or buy back stock?